Hi, this is Shane Handy with the Rational Trader. It's the 20th. We're doing our bi-weekly update here. We're going to talk about the current market volatility and what that means for us. We'll review some data from the Rev 69 model and talk about the 71, and then we're going to talk about what the plans are for ES and CL, and kind of just in general what my plans are for if the market continues to be this crazy. Actually, this is the end of a test that's running here. Once this comes back here, I will stop it here. Maybe. And the problem is that the Sierra chart here is running at like 60x speed, so it doesn't update the screen that often, but I don't want to kill it. All right, so now let's. So it's actually up to Friday here at 10 o'clock. It's at 3150. This is just validating what I showed in last night's video. I think it ends up like 43ish. And this was using settings that I would consider pretty aggressive. They were a limit offset of 1, 10 tick stops though, but not doing the simplified price action at low volume nodes. All right. Now and so seeing that result compared to what I made live was like minus 115. You can get pretty excited about, okay, well maybe this is this particular view is the answer to the volatility. It's not though, and I'm gonna objectively demonstrate that here. Let me show you where's the data. So I took those settings and I ran them for the whole week. And where is it? There's a picture in here somewhere. Is it there? Yeah. And these are the results for Monday through Friday right here. Okay, which is pretty miserable. All right, these are the results for the ES. All right, and so the point is this set down here on the bottom for the ES included low volume node processing. Without the low volume node processing, Monday through Thursday were not quite as bad, but they were all negative, and then Friday was a really good day, like $500. And so what it demonstrates or brings home is that there's a large element of randomness in the environment. And so it's easy to see, hey, if I set things up this way, I could do really well on this day. But then, you have to go do the work to see, well, is there some underlying consistency to that? And there just isn't because of this, right? Because the volatility is just out the window here. All right. And this looked to me, so this is not quite as bad as it was, but it's getting close. All right. I mean, the previous, we're up into the stratosphere here in terms of volatility. And what I found through this is that when we're below this 100 line, I can make it work, though it's iffy. It's iffy in that there's enough randomness in the environment that half the time you're going to get whacked, and the other half you'll do okay. And your average retail trader or small account trader can't deal with that kind of scenario, so you're better off standing aside. If you're at the yellow line, which is 80 points average daily range, then it's worth doing. You can do it. There's enough bigger players in the market that they're damping down the wild swings is what's going on, and you can see it in the order flow, and because you can see it in the order flow, the machine learning system can detect those patterns. But this, when we get above this area here, so if you just look at, let me make this. I made a new one. Darn. Let me get rid of all this. Hold on. So if you're looking at any of these areas here, your results are basically random. Like in between 80 and 100, you can make it work. It's worth doing. But when the volatility is this high, you're truly better off just standing aside, which is not the answer you want, but that's the reality. This is the all boats sink in a hurricane video from earlier in this week. So the question is, what to do. This is the NASDAQ, so I've been putting some more emphasis on the ES because that's a thicker market, and the question was, well, is it more stable because it's a thicker market? My initial look is that no, it's not any more stable. It's, in other words, the bigger players are standing aside in the ES as well, and as a result, that market is whipping around a lot. And because of that, it's just as challenging to trade. All right, and so I think one of the things I'm going to be doing is taking a look at markets that aren't affected by this volatility, or that we would expect not to be, and the commodity markets come to mind. And for me, that would be oil, since I'm an oil trader of old, and it's perked up again after a long time of dormancy. So we're going to take a look at that. That's the initial setup, just so you understand why it's not already done. The initial setup for oil is really hard in terms, well, it's not hard, it's really time consuming. It's like probably 10 or 12 hours of work, of dedicated, tedious effort to just get the data. Once you have it, then you're just adding month by month. But because there's so many contracts, it's much harder. And so just so you understand what's involved, what I have to do, I can't use a continuous contract for this. I have to go get the actual data for the contract that was the front month at the time. So I have to go get each individual contract, figure out when it was the front month, strip off the days that aren't in the front month for that contract, right? And do that for every single contract. There's like 10 or 12 in oil per year. So you're talking about, I need 2 years of data. So there's 20 to 24 of those. And you have to know what the dates are for when it was a front month, which by itself is really challenging. And so you have to do all that work. And once you have that, now you can put it all together and use it. All right. And then every time the front month changes, you just add the new front month, and it's easy. But that initial setup is really ugly. And so that's why it's not already done, since I like the oil market, but man, is it hard to deal with for machine learning because of the data collection problem. All right, so the current volatility is a blessing and a curse here, because what it means is that it gives me some time to go do that, and some motivation to go do it, since I'm getting close to sort of the end goal of the model architecture. So let's talk real quick about that, because what the tests you saw me running here and that have been running live the last couple of weeks have been using Rev 69, which is the difference between Rev 69 and Rev 55. Rev 55 has been in use since March, or maybe April. The difference between the two is that in Rev 55 we put in information in the data itself about the where the wave peaks are and things like that. And then as we move to deal with the volatility, we actually built into the system recognition of when those peaks are, And so that information is in the model now, but not necessary. Okay, and then we added volume profile to get really a much clearer, more, I want to say, more precise identification of where the good places are to enter. All right, and so that means there's other data that I don't need in the model. It's just cluttering up the model. It just adds noise. And so Rev 69 is the removal of a lot of data that the machine learning system no longer needs, because the larger system is picking the locations to enter based on the volume profile. Okay, so that's what's happening with Rev 69. There's two parts to this. One is just look at every bar and use that to train on. And the other is to look at the different areas and train on them separately. So unfortunately, the market is just so messy here. There's not a clean. Let's use this here. So we can look at every bar and use to train on them. And the problem is if the order flow is similar here and here, or radically different, the pattern detection isn't as clean as you want. And so the idea is, since I'm only going to make predictions around this low volume node, then just train on that. And the same thing with the edges. I'm only going to make a prediction at the value area high here. I'm not going to make a prediction unless I'm at one of these edges. So just build the models on that data. And that has a lot of advantages. It has some disadvantages. The advantage is that it reduces the amount of data that you have to deal with, so the models train faster. And that's a big deal as the volatility's gone up, because it's taking 2 and 3 days now for our production models to train every week. I actually have to scramble to get them started as soon as the market closes on Friday, to get them running, and they're not done for 2.5 days before they're ready. So that's a problem that is you can solve by throwing more computing power at it. But if I can get the same result, or a better, actually I'm looking for a better result. If I can get a better result by being more focused on what I'm training the machine on, then I want to go that route. So Rev 69 is aimed at that. That's what these tests are for. I just broke it out. I've been doing it. There's a model where every single bar is trained, and now these recent tests are there's a separate model for each of these areas. Okay. My dilemma is it's really difficult to assess, is that an improvement or not, given the current environment. So the current environment is so volatile, there's so much randomness in the market that you can't do a test and get an answer that you're confident about. Okay, and that's reality. There's nothing I can do about that except accept it. All right. The alternative is to go back to build models. Let me get the weekly out or the daily out. Go back and build models that use data, sort of through here, and then test through here in prep for when the market settle back down. All right. I've not been doing that, and the reason is that there's a lot of effort just to get to a point where you would decide that you want to do that. So I'm getting close to that. The bigger issue, though, is that because of the addition of volume profile into the system, the replays in Sierra chart take way too long. Like this replay here, I kicked off last night at about 10 o'clock, and it was still running. That's just 5 days. Here at, we started at 11, so that's, 13 hours, and you're still even through 5 days. So I have to write a program to do that, and I just haven't had time to do it. I have to write a program that does the same thing as the replay for testing purposes. But we're getting close there to a point where I'm going to do that, so we'll see here. But the main message there is that it's difficult to assess. Okay, is Rev 69 split into separate better than what I'm using today? Because the current environment has too much randomness in it. So you can't just test on this week and go, oh yeah, that's better because I got a better result. There's not enough data. So there's some element of I'm proceeding on faith here down a path to get to a point where I'm confident in the model, and then I got to go do. I need to invest a large amount of time to run a test that goes across 3 months of time in an environment that's more normal. Okay, so there's one more thing that I want to do, which is what Rev 70 will be. Split like this, and then at that point, I'm going to go and do write the program that does replays quicker, basically, so I can get a better look at how well things do and don't work. In the meantime, I'm gonna start bringing up CL, which is, again, we talked earlier, that's a non-trivial effort, but basically what we need is a market that's not quite so crazy. In retrospect, I probably should have done that here when this happened, because here it looked like, okay, we're going back to normal now. So just stay the course. But then now we popped up again. And then kind of the same thing. Okay, we're going back to normal again, but we're not. All right, this has been. I've not seen this level of volatility sustained for this long ever. Since February 2nd, when the wheels fell off the bus here, and then it's just stayed really volatile. So we have to assume it's going to stay that way, which means every day we're going to be making a decision whether you should trade or not. All right. And like last week, I only had the system on 2 days as opposed to all 5. I mean, the idea is you just turn it on and let it go. It would be easy actually for me to go if the average daily range is less than X amount, turn it on. Otherwise, leave it off, and then just turn it on every day. I could do that, but since I'm watching it, I just make that decision manually. Okay, so we're basically in search of less volatile markets until this settles down. Is the main message here? Every day is a question mark right now. Given how high that volatility is, some time has to go by before it's going to get back down to where it's reasonable. All right. So if you just look at the past. All right, look how many days it took before it got back below 100. That's like 3 weeks. Here it was even longer because it fell and then climbed back up before it finally came down. That's a full April 5th to May 24th, almost 2 months before it settled back down, all right, to where it was tradable. All right, so that's, you got to keep that in mind. It might be a while. So since, understanding that, okay, let's go search for some less volatile markets. So oil is the obvious one, that just because I'm an oil trader from long ago and I know it's picked up again. I'd be interested in other markets that people are that you trade that are not as volatile. I'll take a look at them and see. And then you end up, it would have to be something non-correlated to the stock market, of course. So, whether that's a currency market or the bond market or whatever, I don't know. The commodities are an obvious choice. So I'm gonna bring up CL, and then if you have an opinion, talk to me, and we'll see, or tell me, and we'll talk about it, and then decide what to do. So do you know for a fact, Robert, that bonds are not as volatile, or you just like bonds? One of the problems that bonds present to the small account trader is that the value per tick is pretty high, and just getting inside the just kind of standard variation can be tricky for the small account trader. That's why it's always been a little problematic. Yeah, so you just like bonds. That's not a good enough answer. So, it's easy. Just take this chart and look at it and see, what is the range done over the last. You can compare it to this. Actually, it's I would imagine bonds are very highly correlated to the stock market. It used to be they were inversely correlated, but then we started printing money in 2009, and things changed, and now it's quite a bit more complex in terms of trying to figure it out. Since I think people didn't really understand what would happen when all the central banks in the world started printing cash to deal with the crisis that happened. Started building debt. Okay, so more votes for CL. But okay, did I cover everything? I don't have too much because we're basically in sort of a holding pattern in terms of the stock market here because of this craziness. Let's make sure I covered everything. Market volatility 69.78. ES I want to continue to look at. It is a thicker market, so you would expect it to be a little bit easier to deal with. But the fact is that I don't have the chart up here, but the fact is that it's making huge moves also. And so that's because it's making big reversals like that. That's how you know that the larger traders are standing aside. The people that are well capitalized they're not willing to commit their capital to the market because it's too unpredictable. That should tell you something about what you should be doing. Okay, so just a quick update this week. Next week will be next week in the trading. It will be exactly the same. We'll bring everything up, and I'll be. Oh, you know what? I'm sorry, I didn't talk about one thing. I implemented this feature here in testing, which is not quite ready yet. So this is the concept of continuing to trade until you lose X amount. And so what I saw just in the volatility recently is, I'd be up nicely, but then end up down badly by the end of the day, and you don't want that, right? And so what I've implemented here in the spreadsheet is to disable the trading if you lose X amount from your peak. All right, so it's actually not that. It turned out to be not that difficult to do. I need to do a little more testing, make sure my logic is correct. But in Sierra Chart, they have a study called Trading Closed P&L. So this value is your what the current close profit and loss is for that market for the day. And in the spreadsheet, it's very easy to track the maximum value and then use that to figure out, okay, well, if compare the current P&L against the maximum P&L, and then if it's more than a certain amount, stop. It's not that difficult. Once you've got this value, once you got this number, the rest is easy. And so that's in testing right now. I talked about it in last night's video, so there's some more details there. I think I've got there's one issue there, and I saw that didn't quite seem right. I'd like to understand that before I release that out. So we had some conversations. In fact, Randy's making a comment here in the chat about putting in a limit to the number, like a hard limit on, I won't take more than X number of trades, and that I just don't like. It's not adaptive enough, because the reality is you don't really care. The concern there is over trading, okay, and which I completely agree. We don't want to overtrade. As a general rule, what the system we've built here does not overtrade. It doesn't take a zillion trades. When the market's moving a lot, of course, there are more opportunities. So, of course, more trades come up. But in a normal market, this system doesn't overtrade. Not by any stretch of the imagination. It does. We're very particular about where we enter. But when the market is moving, that means there are more opportunities. So you want to try to take advantage of those opportunities. And you don't actually care that you are taking more trades if those trades are profitable. You do care if you're giving back a lot. You would also care if you were taking a lot of trades and just scratching. You'd care a little bit. It doesn't quite matter so much, because a scratch for us is enough to cover the commission costs. So the compromise there is, okay, well, what I really care about is if I'm trading and losing after I've been doing well. So that's what the concept behind the give back is. If I'm up and I give back, I have it currently set to the same value as the max daily loss. If I give back this amount, then just stop trading. It needs one more piece of logic that I don't have in there. It needs some logic that says, if I've made X amount, then start looking to see if I give back too much. That's what's missing. So currently it just goes, all right, well, whatever your max is, if you lose whatever number you put here. So let's say you put 100 here. Well, the problem is your max profit is 0 at this point. And if you take one losing trade that risks $100, well, you've given back given the current logic, you've given back $100. It'll stop trading. That's not what we want. What we want is, if you get up X amount, then implement this give back. Start give back logic. So another piece of information is needed. Like, how much do I need to get up first before I start looking to worry about giving back too much? So it would be something on the order of, if I've made 200, then I don't want to lose more than 200. Or if I've made 150, then I don't want to lose more than 200. Or something like that, something along those lines. So that's the logic that's missing. So I need to add that. And it's the same thing. It's not we have the data to do it. It's just the logic in the spreadsheet has to be implemented. It's pretty simple, actually. Since you know what the max has been, since it's being tracked right here, since I know the max, okay, that number has to get above my minimum requirement before I start implementing the give back logic. It's easy to do. I didn't realize it until I was doing some tests here that I missed that. Yeah, and I like that better than this, actually. So this is Randy's point, is that this is a hard limit on the profit. This says if I make $1,000, stop. I philosophically, I really dislike that because that's limiting your upside. So I'd rather have this be some huge number that you'll basically never hit, and just let the system stop you if you lose too much. I think that makes a lot more sense to me. Having said that, I did look at setting this in the current volatility. One approach to take is to set this number to something like 200 or 300, and if you get that stop, and it's, again, to me, it's like if you do that, then you limit those days where you can really just hit grand slams. But there were because the markets are so volatile, there were a bunch of days where I was up nicely, and if I had just stopped and then did that every day for that week, I'd have been pretty happy with the result that week. So that, you can be doing that. One of the problems is figuring out what that number is. Again, I have a philosophical problem with it, since I think limiting the upside is the wrong thing to do. But I would rather, I'm more inclined to simply stand aside than to do this. I'd rather just not trade than try to eke out some small amount in this crazy environment. Basically hoping I make some small amount. Because again, what makes us successful as traders is that there's an asymmetry between the risk and the reward. So, if I'm willing to risk $300 a day, then I want my reward to be more than that. Is kind of my philosophy. Now that might be counterproductive in the current environment, but that's just how I feel. Nonetheless, the feature's there, and you can make use of it. It may have to be a percentage of the max. So what Clint is saying is, that's interesting. This value, instead of being a dollar value, to be a percentage value of the maximum. Now, you could actually do that yourself very easily just by putting a formula in here that says equal to max times whatever your percentage is. If you wanted to do that, Clint. So the max is, if you want to do that, just tell me, and I'll show you what to do. That's very easy without me having to do anything, because you just change this number will just change based upon the max value. There's a little logic that has to be done, but it's not that big a deal. That's an interesting idea. You have to be careful when you start thinking that through. It's a percentage of the max value after you've reached a certain profit level. Otherwise, the percentage will be too small. Okay. All right. So this will be coming. It's just a matter of when's the next time I release something out. It might be when I the obvious time would be when I release an oil spreadsheet, which at the time might be implementing a Rev 69 and Rev 70. So that would be the time that we would see that. In the meantime, you'll see every morning. You'll see in the room. You see me going, okay, am I going to do this or not? Making that choice. The easy way to make the choice is if you're above 100. Don't do it. All right. What I do is now I look at it and go, what does the depth of market look like in the dome? So if the dome is single digits in the depth of market for NQ, then that's it. I'm not going to do it. That's way too crazy. If it's more than that, if it's double digits, which is kind of what you normally see, and it's not moving, it's not whipping around, then I'm willing to give it a try. Otherwise, I'll just stand aside. And it's anybody's guess what'll happen here. I mean, if we look at just looking at recent history, we've had some really scary times here. And then people were talking about the end of the world here. And then the market just kept climbing, Another really scary time, and then, the market just kept climbing. So here we are again, a really scary time. This is panic and fear. This is a physical manifestation of panic and fear in the market. And now what? I don't know. We'll see. I have no prediction whatsoever. Anyone making predictions is a fool, I think. And just be careful of the news and the media, all right? Because their job is not to actually to give you information. That's not their primary goal. They're measured by ratings, and so their primary goal is to get your attention. And so, when stuff like this happens, the first thing they do is they go find those people who are always talking about the market's going to crash, and they put them front and center. And then they have somebody else who's bullish on the market, and they just have those two people, duke it out. The media actually likes this because it's alarming, and so it gets people's attention, and then people watch, and their ratings go up. And anyway, you're better off, I think, not even watching the news. But if you do watch it, just make sure you're gonna have an emotional reaction to what they're saying. Take a step back and let your intellect kick in, and remember that these people don't know anything about what's actually happening. They can't predict the future any better than you. All right. And it's very, very unlikely they're actual traders. All right. The real traders aren't talking about what they're doing. So just keep that in mind when you're reading the news. They're after your attention. In today's world, they're after your clicks, right? A lot of titles are clickbait. Okay. Any last questions here before we wrap it up for today? I got a lot to do. I got to think about oil here and how to go about doing that in the most efficient way possible. In the meantime, models are running, so they'll come out tomorrow like normal. Though it will be later because it just takes longer now, since there's so many bars. I'll have Rev 69 split like this running next week for ES and NQ again in Sim, and then we'll see how far I get on oil. Oil's challenging. If you want to, do we download new chart books for Rev 69? So you don't have Rev 69 yet, Randy. You just have, you still have Rev 55. So the Revs refer to the machine learning model. Okay. There's a server out there that's 0730 July 30th, and then there's a server out there that's 09, is it 21? I think it's 0921, September 21st. All right, and these servers are different than where is it? Yeah, 0921. The servers don't match to the machine learning models. They're orthogonal. They're separate. So the 0921 server implements low volume node processing. That's what it does. Okay, so the specialized processing at low volume nodes, which I would love to see work which I'd love to see live in a normal environment, since it was built specifically to deal with the cases where there's a low volume node and the market just bounces right off of it or blows right through it, and it doesn't give us any price action to work with to see that there's something to do there. But the markets are too volatile now to use it, so we just have to wait. It's the universe is laughing at me. I built that feature. It's going to be really, really useful. But in the current environment, it works against you because the markets are too wild. They're too whippy. The whippiness works against simplified price action. So the more complex price action of the normal rational trader codes are more useful right now. You may not have access. So Randy's asking, we won't have access to Rev 69 until after the test. That statement is true for everything. I never give you anything until I've tested it. But I'm going to build Rev 70 here shortly, and we may skip right past 69 to 70, but we're close here. It's either 69 or 70. There's one thing I need to add into the model that is currently not there that I need to put in, and then at that point the question becomes, okay, well, is it better than Rev 55 or not? And you can't answer that question in the current environment because the current environment is too random. So there's a dilemma. What do we do? And to me, the answer is, well, you've got to go back to when the market's not so volatile and look at it and evaluate it that way. You can also the other thing that I will do is, so I'll end up doing two tests so you guys understand. I'll end up doing a test that basically builds data through here and then tests through here. Okay. And then I'll do another test that builds data through October, probably through here, and then tests through here. All right. So that we have to have an understanding of, okay, well, what is the impact of using that? And this likely requires quite a bit more tuning because the market's so crazy. The question is, if any result that you get here is of questionable value, since there's too much randomness. So again, I can't overemphasize, if nobody, nothing in the world can predict the flip of the coin or the roll of the dice, nothing, or the spin of the roulette wheel, nothing can do it. And so that's what this is to me. This is that kind of environment. So to me, it's not really useful to run a test here. This is more really what I ought to do. I'm just talking about it here with you guys. Is test kind of like that area. All right. So from when it settled down to the time when it picked up again, when it went crazy again. These results are going to be different than the ones from a test in more normal environments, but that's more useful than including all of this crap. All right, so that's likely what I'll do. But I'll show you. I'll tell you what I've done. All right, so there's no mystery there. Because there's less randomness in the environment here than there is here. To me, these days are just literally, just go play roulette, just go play, go play some dice game, craps or something. That's what it's like. So testing against that doesn't necessarily have that much value. Okay. And in fact, it might be more meaningful to limit the test to days where either the average daily range is less than this amount or the daily range itself is less than some amount. So come down to here and draw a line. And from a testing perspective, like don't run your test on days where the range is greater than a certain number. And that's a way to eliminate those noisy days. That thinking it through, that makes a lot more sense actually. So I got to think about that. That's not difficult to implement in a test plan. It's just you just need the data on what was the range of the day. You can see like down here, and the subgraph down at the bottom is the average daily range. You can see that day was insane. You're right. So running a test against that day is really not that useful. So where is the line? I don't know, but it's not that hard to figure out because I know for a fact that the approach works cleanly, up until the market got crazy. So you can come back to here and figure out where that line is. It's probably in this, the average daily range is, or not the average, but the daily range is in the, 100 area or something. You can see it's I'm looking at this number over here. It's like, well, I'm just, something like that. If it's less than 100, go ahead and test on that day. Otherwise, skip the day. That kind of thing. And that helps us understand, do I have something useful? Boy, this conversation has been really helpful. It's really clear, and that just really clarified my thinking on what to do. Because my dilemma is figuring out do these changes, do they help or not? And since the current environment is too random, you can't really tell. The problem, of course, is that I have to write the program to do that, since the replays take too long. As soon as we introduced volume profile, the replays take too long now. So I got to go write the program to do that. Once that's written, though, it'll be easy. You'll just say, okay, show me, here's my model with data built through here. Show me the results for every day after that using these settings. But only test days where the day's range was less than 150, less than 100, less than 80. That's actually a really interesting idea. Or you can do the same thing with the ADR, where the ADR was less than this amount, and that'll help you draw these lines on when to participate and when not to. Yeah, I like that idea. Do you think CL would be a 6-tick, 10-tick, or some other model? You're talking about the range bar height. I used to trade 10-tick range bars in CL. That was back when it was at $100, when it ranged between $70 and $120 a barrel. It kind of just cycled through those levels. As the market quieted down, actually, that's not the correct way to say that. The oil market collapsed and fell below $50 a barrel and stayed there for a long time. And then it would cycle, but it finally got to a point where it was cycling between like 50 and 60 and peaking to 70 and then coming back down. And when that happened, I started playing with the range bar heights. And so I don't know. I'd have to look at it right now. I would start with 10 and then work from there. It's the same. It's the same issue. You need to find the balance between signal and noise. And I'm just looking for any other questions here, and then before we wrap it up. My bigger problem, Larry, is just getting the data. So I'm not really thinking at the moment about what how to represent the data on the chart at the moment. It's just getting it. Getting it is hard because of all the contracts. Just figuring out the rollover dates is tough. I was talking to Patrick about it, and he showed me a way that'll help, but it's still pretty painful. In any case, we'll take a look at it and see if it's less volatile. Then I'd much rather deal with that than this current craziness. All right, gang. That's it for today. Did I get every questions? Oh wait, John has a question. Is there a way to measure whether certain markets tend to work well with volume profile or not? No, that's a really interesting question. I don't know a way to objectively measure that, John. The easy thing to do as a human is just look at the daily volume profiles for that market, and if it looks like a regular model, like a regular distribution, or a couple of regular distributions, then the answer would be yes. So what you want is, here, let me see real quick. There's too much stuff on screen. So do you see how it might be hard for you to see, but there's the gray here, because these are crazy. See this gray distribution like this. If it's packed, what you would expect to see is a distribution that looks like that, and there might be another one of them, and that's fine. Because what will happen is the market will trade and then break and then trade. All right, so if you look at volume profile theory, it talks about the kind of the shape of those volume profiles, and they give them names like a B shape and a D shape and a P shape, where depending on how the market moves. So when the market advances and then builds volume, you get, a big profile up here, and it's really thin down here. This is very normal to see that, and the reverse is true as well. The market falls and then builds volume. If it would just do that, we would be in Fat City. You also see cases where it's bimodal, where it trades sideways. It trades in a range and then breaks out and then builds another volume. And this is what we're interested in. What's happening now is the market's just going like it's just falling and screaming and falling and screaming. It's never spending any time anywhere, and so you can just look. You can look at it. You can use Sierra chart to draw the daily profile for you and tell very quickly, oh yeah, this looks fine, or no, this is crazy. And I would bet that any kind of thick market, the volume profile is going to work well. Thinner markets, less so. And then it'll correlate directly to the volatility. So it'll correlate directly to what we're looking at here. All right. So when the range of the market goes up, the volume profile becomes less useful, right? Because it means you're spending less time building that profile. Okay. That's a good question. Okay, that's it for today, gang. Thanks a lot. I've got some work to do. I got some thinking to do here, and then I've got some work to do. Okay, I will see you on Monday. Have a great weekend. Take care.